So as lead economist in Turkey, we're observing the macroeconomic context for fiscal policy, if you like. And I wanted to start just providing a little bit of context and then talk a bit very broadly about first order and second order impacts of inflation in the current macro environment on not just budgeting for 23, but also the outturns we're seeing relative to 22 plan. So essentially, the authorities have, over the last 10 years, actually, developed significant fiscal space with debt to GDP levels rising only recently to around 40%. The economy is also growing rapidly. Last year, coming out of COVID at 11.4% in real terms. But also note that it's many times that in nominal terms, which is important for our fiscal stability indicators. Government continues to pursue a growth-oriented policy with loose monetary policy, but also an attempt to tackle inflation from the supply side in response to what is, as Bill set out, and you set out, I think, Ian, near record high inflation. In August, CPI inflation rose for the 15th consecutive month to 80.2%, and expectations nevertheless are for about 40% in 2023 and lowering further to about 20% in 2024. And I know the authorities in the medium-term program have a steeper path for bringing inflation under control, which Osman Nuri will talk about. In parallel, it's also important to note for fiscal and budgeting purposes that the exchange rate has depreciated sharply, roughly halving in value last year and depreciating a further 30% this year, which has implications for external costs in the budget. All the signs are that this approach will continue through next year's budget framework, so using fiscal space then to curb the impacts of some of this policy on inflation and the impacts of inflation on households and firms. So just briefly looking at the first order effects, which mirror very much what Bill was setting out. Indeed, directly, inflation has caused an increase in nominal expenditures, partly through indexation and the nominal cost of goods and services. On the debt service side, the real value, as Bill also was setting, of debt has of course declined, but there's also been a rise in risk premia for government access to finance. And the exchange rate depreciation attendant to the inflation story has also driven up external debt service costs. On the revenue side, however, a large boost, as Bill also was setting out the opportunity for, especially through corporate profits in nominal terms, but also on the external trade balance and trade taxes. Turning very briefly to the second order effects, in terms of the policy responses to this high inflation environment. On the expenditure side, large public wage increases, but also increase in tax expenditures through cuts on VAT, on food and energy to try and bring headline inflation under control. And importantly, a very important policy measure in the form of a deposit scheme that protects people who hold their money in lira from the depreciation in the lira. Now, there are a series of incentives to bring money into that deposit scheme, which results in tax expenditures, foregone revenues. But there's also realized costs as the exchange rate has depreciated, the government has compensated for those losses. And then there's a contingent liability associated with that, as holders and new entrants to the scheme will need in the future to be compensated for the lira depreciation, should that happen, against the US dollar. So nevertheless, in summary, to hand over to Osman Nuri Bey, as Bill also concluded, overall not a complete given that this is a net negative. In fact, in realization terms, we estimate that central government fiscal deficit narrowed to 1.6% of GDP in the first half of 2022. But let me turn to Osman Nuri Bey to give us the real detail on how it looks going forward also. Thank you very much.
Uh, Thank you very much, Hans. Thank you very much for the event. Please let me share my screen. So I hope you can see the slide, right? Okay, no problem, I
Yes, we
think.
can see your slide.
Okay, thank you. Thank you very much again for the event. I can start with why inflation is a bad thing in the first place. It, you know all, but it lowers the purchasing power and hurts the poor and fixed income groups disproportionately. And another aspect is when the inflation is high, it feeds on itself. In the expectations worsen, and the inflation makes gets higher uncertainty for all economic agents. And besides that, high inflation is more volatile. It distorts relative prices. Uh, the problem with the inflation is it's not just let me say that assume an economy in which prices, wages, everything rises by 50%, but everything. Then in that case, it will be just an coefficient on the money, but it is not the case in real terms. So when inflation gets high, it is more volatile. That's why it gets it makes extra uncertainty. And when it leads to higher interest rates, it hurts growth and employment afterwards. Although in the short term, inflation may help to growth and employment, but eventually it hurts it. So it's like a fog on the road. It slows down everything eventually. So let me speak on the classical public finance measures to control inflation. In normal times, especially, to combat with inflation, you reduce private spending by increasing taxes, mainly, and you decrease government expenditures, namely cutting down some non-rigid expenditures such as goods and services procurements, investment expenditures, etc. So you decrease the deficit, you borrow less, so you are able to tighten the monetary base. But what if there is a supply side shock in the economy? We experience vast increases in energy and other commodity prices, and uh, raising interest rates may not be that helpful to solve supply side problems, and it even further risks of overcooling the economy and make the problems worse in the supply side. So in those times, it's also very hard for the market mechanism to allocate resources properly. I mean, in this kind of supply side high inflation times, the deteriorated cost structure and the expectations distort the price signals also. So it forces us to think somehow outside of the market mechanism. So price controls and subsidies may be inevitable for governments. But of course, it requires very careful managing of inefficiencies it creates. Another aspect is you still have to avoid the price-wage spiral, but you have to protect the social groups at the same time. And it's not just for inequality, it's also for preventing a total collapse in the aggregate demand. Because without some level of demand, you cannot keep supply alive. There's a need of a more careful and maybe a non-standard approach to control inflation. So, budgeting at times of high inflation, what should you do in this framework, in this context? You may adopt a tailored approach to high inflation with supply side problems. When you have high inflation, rising inflation both increases revenues and expenditures in nominal terms, but increase of some expenditures lag behind. So a fiscal space occurs. We can say inflation tax. And if you haven't raised the interest rates compatible with the inflation, so negative real interest rates may also contribute to that fiscal space by lowering the interest expenditures to GDP ratio. So how to use this fiscal space? Firstly, I must say that it is important to maintain some level of public investment is crucial for supporting the supply side, especially for the critical sectors. And additional incentives for private investments in critical sectors also important. As I said, you have to keep supply side alive. And transfers due to energy prices and maybe some other subsidies may occur. I must say some few things about that. In normal times, say for example, the natural gas prices have increased, so the most efficient way may seem like you reflect the prices and make the subsidy just for the poor. That may be correct, but if you have such a big shock in those prices, you may be forced to make a general subsidy, temporarily of course, but make it general. And another thing is transfers to vulnerable social groups are also important because especially for the Turkey, pensions and personnel expenditures are linked to CPI, but there's a backward indexation. So when inflation is rising, because of the backward indexation, the personnel expenditures to GDP ratio, the pension expenditures to GDP ratio temporarily falls down. When you have a supply side shock, supply side inflation, you can expect a higher PPI than the CPI. So the GDP deflator occurs somewhere between CPI and PPI. That means CPI may also fall behind the deflator, and for that difference, you may also think of making some extra transfers to the vulnerable social groups, and some temporary tax reliefs on some consumption taxes. You can discuss it. All of the things I said up till now is some. It's not about tightening. It's for the opposite direction. But it it is still valid that when budgeting, when managing the public finance, you still have to have a strong fiscal stance. So you have to tighten some areas also. It's not easy, I know. It's like using the gas pedal and the brake pedal at the same time, but sometimes if you have to make a drift, you may have to do so. Let me continue. So you may think of extra taxation for extra profits, maybe for some corporate taxes. And in high inflation times, you can use the opportunity to change the revenue structure. I mean, shifting to a more redistributive one. As I said, it is important to be able to have a solid fiscal stance, and you must show it in a medium-term frame. Take close attention, especially for the period in which your inflation is projected to decline. So in that period, inflation tax is no longer available. So how it may be possible for fiscal consolidation being possible, spending reviews and resurging foregone revenues may help. I agree, it's not easy to find an optimal way, and it is a little bit risky also, like walking on a rope. So let me continue with the Turkish case. As you said, yes, end of year CPI, it was already rising to 36% in 2021, and it is forecasted to reach 65% in 2022. But last month, as Hans said, it is slightly above the 80%, yes, and it will come down to 65% it's projected to come down to 65% because some of the base effects will remove by the end of the December, but of course still very high. And we are projecting the inflation to be in 2023 around 25% after elimination of the energy price shocks. And as Hans said, in Turkish case, we have a double shock, both the energy and other price shocks and the accompanying currency depreciation shock. So our CPI is projected to come down to below the 10% by 2025, very long periods. Our real GDP growth forecast is 5% in 22 and 23, and 5.5% in 24 and 25. So we are expecting real GDP growth near our potential output increase level. And our budget deficit to GDP ratio is programmed to be 3.5 in 2023 and gradually come down to 5.5% in 2025. I can return to this table, but for the Turkish case, firstly, in 2022, as my other colleagues said, in Turkish case, also tax revenues increased, in our case mainly by corporate taxes and imported goods VAT. And for the revenue side, the GDP ratio of revenues are projected to increase and remain high in our medium-term periods. Let me show you our tax revenues. We project and increase our tax revenues and stay at that high level. It is possible for the Turkish case because we can research some previous tax reliefs and adjustments in corporate taxes make it possible. By the way, I must highlight that in Turkey, especially for the last 10 years, we have increased our tax expenditures substantially. I mean, it is somewhere around 3 to 4% of GDP, our foregone tax revenues. So we have a space, fiscal space from that. And let me continue with the expenditure side. In 2022, there are huge subsidies in Turkey for the aim of not fully reflecting the energy price hikes to households and producers, but mostly households. So in our medium-term program periods, we program to maintain some level of subsidies. And in Turkish case, we preserve our pre-2021 levels of public investments to GDP. We don't cut further down. In 2023, our expenditures to GDP peaks up to 24%, mainly because of additional transfers to households and some other expenditures. But in our medium-term frame, it will follow a decreasing path afterwards. So for the Turkish case, I must highlight that, yes, there are lots of risks, but maybe it may sound counterintuitive, but a quick fiscal consolidation is feasible. Why? Because as a float, the inflation wipes out everything, and it includes the previous extra expenditures on the budget. It also eroded it. So I can say that inflation resets the expenditure structure of the budget, and there is an opportunity to make a shift in the revenue structure, put more weight on the corporate taxes and maybe resurging some foregone revenues. So for the Turkish case, we have programmed a primary surplus of 0.5 in 2024 and 1.3 in 2025. Let me show you the central government budget, our medium-term program figures. Thank you very much for listening to me.